Thank you, Angela. Rushanara.
Thank you. I've got some questions on fiscal consolidation. The Chancellor emphasised in his autumn statement that with under half of the 55 billion consolidation coming from tax and just over half from spending, this is a balanced plan for stability. Looking at the overall picture, what proportion of the government's fiscal consolidation overall would you say comes from tax and spending, and how does this compare with the fiscal consolidation of 2010?
I might ask Andy to come in, given I've been talking a lot.
So there's a few ways of looking at this, because there have been many fiscal events since our last forecast. So in terms of the measures that this Chancellor has announced in the autumn statement, and also the decision not to go ahead with cutting the basic rate of income tax that was announced on the 17th, that, in our forecast, adds up to 62 billion in the final year.
Can you say that again?
It adds up to 62 billion in the final year of the forecast, which is precisely half and half tax and spending. Mm-hmm. The difference with the Treasury's numbers is they separated out that basic rate income tax measure, so that's why they get the 55 rather than 62, but let's not split hairs. Looking at things relative to policy as it stood in March, so how it has changed our forecasts, the consolidation is worth about £40 billion in the final year, and that's simply because part of this Chancellor's consolidation is to cover the surviving tax cuts from the growth plan, of which the health and social care levy is by far the largest. So that consolidation is about a quarter tax and about 3/4 spending. Mm-hmm. Perhaps a more pertinent measure is what will happen, rather than considering it relative to a baseline of a different set of policies, what is planned to happen over the medium term. So if you look at spending and tax relative to where they stood in 2019, spending rises by about 4% of GDP in 8 years, and so does the tax burden. Mm-hmm. So in that sense, it's an expansion of both state and tax burden over that period. Now, if you compare it back to what happened in 2010, both what was planned over 5 years and I guess what was delivered over about 8 years, the share was about 80% spending and about 20% tax. And also, in a sense, it led to a shrinking of the state and a very, very modest rise in the tax burden through raising VAT.
Mm-hmm. Okay. We were promised by a few chancellors ago, but I forget which one, that austerity was over. But austerity is clearly back now, from what you said. And the IFS said that the British people have just got a lot poorer. The Bank of England governor, when he came and gave evidence, said that the US obviously has grown by 4.2% since the pandemic. The GDP of the Eurozone countries is 2.1%, and yet the UK economy is 0.7%. It's smaller than at the start of the pandemic. These are very worrying numbers for us. Obviously, he also talked about particular shocks. Paul Johnson talks about own goals. The statement, autumn statement, has stabilised things, perhaps, in the light of the fiasco of the mini-budget, fiasco in your organisation being left out of the loop. How do we get out of this doom loop? What should happen in terms of generating growth, and are the steps that have been taken insufficient to be able to get us out of this hellhole that we're in?
We need to be careful about providing policy advice to either government or this committee, but in terms of what we're currently assuming about the growth outlook, and maybe what is holding that back. David, do you want to say a few words?
I think relative to where we were in March, which was not a particularly comfortable position to be in even in March, because energy prices had already gone up quite a bit, and the recovery from the pandemic was being held back slightly by a much lower labour supply than we thought. So even in March, things were not tremendously optimistic in terms of the outlook. But the things that have really happened since then, I think, explain the scale of the shock to the population in the UK. And they are increases in interest rates of a scale that simply wasn't on the cards back in March, and a further but very large increase in energy prices. So if it,
And just sorry, just on the increase in interest rates,
Yes.
you're referring to what happened in September and having a material
I-
impact.
I-
Obviously, we've
I-
had the monthly
Yeah.
increase anyway before September.
yes,
Could
I
you
mean,
just
yes, absolutely.
separate the two
So-
out
so-
and explain?
What happened in September was an increase. There'd been then an increase in interest rates, which was significantly higher in the UK than in most other industrialised Western countries.
Yeah.
But that, what you might call excess increase in interest rates in the UK, has all but disappeared
Yeah.
now. So by the time we do our autumn statement OBR forecast, really what's happened is that the increase in interest rates in the UK looks pretty much in line with the global increase in interest rates. But it's very big. Just as an illustration of that, if you took 10-year government bond yields that we had back at the time of March, they were about 1.3, 1.4%, and financial markets were expecting that that's where they'd stay pretty much. By the time we came to do the forecast a couple of weeks ago, they were 3.6, so it wasn't far off a tripling in interest rates. And given the stock of debt that households own and that the government owns, that's a very big hit indeed. The energy price increase is also very large. So again, if you go back to the time of March, market expectations for where gas prices were going to be on average in 2023, back in March, were very much lower than they are right now. So right now they're about 80% higher in the global markets. This has affected anybody who imports gas. So I think those are the two big things that have made the UK, coming back to Paul Johnson's statement about the people of the UK just got poorer. I mean, those are the two reasons why it happened. I think the good news is that it's plausible that both of those effects will be somewhat attenuated as you look into the future. I mean, I already mentioned that if you look at the financial market projections as to where energy prices go, actually they fall back quite a lot over the next couple of years. That's very good for households. It's very good for companies in the UK. And even in the short period since we produced the forecast, interest rates have continued to move down a little bit. Mm-hmm. And the projections for where Bank of England bank rate have always been a little bit lower 2 or 3 years down the road. And our own projections for where mortgage rates go is that it might peak. The average interest rate on the stock of mortgages will go up for a while, but then it will turn the corner and start heading back downwards again based on market forecasts for where interest rates will go. So I think 2023 is going to be a very difficult year, very likely, but the years after it will not be quite as bad.
Mm-hmm. Thank you. So just going on to public sector net debt, excluding the Bank of England and the underlying measures of debt, it rises to a peak of 97.6% of GDP in 2025 to 26 before falling. Can you talk us through what the triggers would be, which would enable UK public debt to fall as a proportion of GDP?
So there's two reasons why public debt turns around towards the end of the forecast. One is that as energy prices and interest rates fall, although remaining higher than previously assumed, that gives support to the economy. So if you think of energy prices as the price of an essential, it's almost like a tax rise that we're facing at the moment, and it's almost like a tax cut when those energy prices fall back. And so that recovery in GDP growth means that debt over GDP, the GDP is growing more strongly, and that helps. The second reason is the fiscal consolidation measures that were taken in the autumn statement, which are enough to bring borrowing down sufficiently that debt rises more slowly than GDP. So without those measures, debt would have risen forevermore. With them, it stabilises and it falls by a very tiny margin at the end of the forecast.
Okay, just one more question, which just wanted to see if you concur. Yesterday, the chief economist of Pantheon Economics said that the number of people who are out of work because of being on the NHS waiting list, there are about since 2020 we've seen a rise of roughly 400,000 in the number of people who are of working age but economically inactive. And that's about 1.2% hit on the size of the workforce. When pushed, he thought that it could be a 0.7% hit to the workforce in terms of output. Would you agree with those figures?
So it's certainly the case that one of the, as David was mentioning, one of the reasons why we, on top of the reasons David gave, another reason why we came out of the pandemic with a lower level of output than and we're going into this next crisis from a lower level of output than other countries, is that we've been a bit unusual in seeing rates of labour market inactivity go up after the pandemic. For a lot of other advanced economies, they actually saw labour participation rise, so inactivity fall in the wake of the pandemic. But nobody really understands entirely why that's happened in those countries and why we've had the opposite effect. The reasons do appear to be complex. There's a mixture of health factors. There seems to be a strong element of early retirement, given the age profile of people who left the labour force during the pandemic and are now not reappearing afterwards. To the extent that a large number of those people are in the older age group, we're fairly pessimistic about their prospects for rejoining the labour market over the course of the forecast that we have here. We have some return, but not very many. So you're still losing hundreds of thousands of people from the labour force, from some combination of ill health, early retirement, and other factors that appear to have come to pass during the pandemic. And it is something which holds back output growth and the level of output.
And there are 7 million people on waiting lists, so some of those people do want to return to the labour market, which could. So the question was about this 0.7% hit.
It's something that we want to look into. It would be wrong of us to pretend that we know the dynamics of this. It's something that we definitely want to look into in more detail, because our forecast heretofore have been based on what had been more optimistic assumptions about returns to the labour market. I think we want to better understand both what the data says about why they're out of the labour market and also what the evidence says about why they're coming back in. We will look at it in more detail, but we didn't get a chance to in this.
Thank you.
Thank you so much, Rushanara. Anthony.